Doing a quick sound check. Thanks everyone for showing up. Appreciate it. Welcome from Perth. I lived in Australia for 6 months and never made it out there. Get going here in about 2 minutes, folks. Hey Greg, welcome. Figure we need to keep the rock music rolling here. Oh, 1 minute. Welcome everyone. It is 9 p.m. Eastern and getting ready for Wednesday commentary here. I've got the cold weather gear on in northern Arizona. It's starting to cool down, so we're going a little bit casual tonight. Just going to get a lot to cover, I think, as we see the markets continue to move into all-time new highs. Just a quick review before I get into tonight's monologue. Let's review yesterday. S&P up 0.2, NASDAQ up 0.1, Russell down 0.4, so we lost a little ground there on that spread that I'll be covering here shortly. But then we also had basically earnings are driving the market. We saw the market drive up all the way to the RXT number on the cash, almost exact hit, and then it got rejected there. I put that out on Twitter. And then we had ended up with this really, I think, was an ugly close to say the least as far as the intraday action went. So we'll cover that again here in a minute. But the S&P earnings are coming out 83% so far. Just the ones out of the constituent list of S&P stocks are up, beating by 83%. And I always go through this dialogue. Is this really about they're better, or is this that the analysts are bad? I've been throwing that around for decades, trying to figure that out. And I think they're just bad, and maybe it's not a conspiracy that somehow everything gets underestimated. So we come into every earnings season, and there seems to be a boost in the market, but it sure seems to work that way, doesn't it? So you don't really want to get too negative in most earnings seasons as they come through. And we've got several more weeks actually of numbers. And, it's just interesting to see how these big techs are coming out. Microsoft and all of these guys are just pretty much blowing the doors off for the most part. Some of the chips, I think Texas Instruments came out with some pretty ugly numbers, but I don't know how relevant they are in the big schemes of things, but all of the other folks continue to do pretty well. And just real quick, let's review all the economics, and I'll go into what I want to talk about tonight on the opening monologue. We saw a couple things. New home sales actually came in better. I thought they might. They were expected 750. They were up at 800, and that was a 14% month-over-month increase. So that's a pretty big number. The Case-Shiller numbers, which give us the pricing mechanisms there, was up 19.8 year over year. So real estate still a pretty good investment. I know I mentioned last night about that situation in Denver that was going on with 100 offers on one house. That was actually a piece of junk, so I understand. But no one cared. They just want to buy it, flip it. Everybody wants to play, right? So maybe it's a little frothy. And I know some areas like in New York and other places are not that way. But I can tell you it's absolutely crazy here. If you decided to come out to where in the region where I'm at and say I want to build a new custom home, fat chance. I can tell you not only will it cost you more than you ever imagined, it is actually impossible to find someone to build it for you. Everybody is like booked, and I don't know how far out. I talked to somebody not that long ago, and they're definitely booked out into next year. And we pretty much have a year-round building season here. We're not as far up like in Flagstaff. It's a lot colder up that way. But let's talk about the other thing that came out. Consumer confidence came in at 133.8. It was expected 110, so that was better. So all these October numbers are still coming in better. And I know that I've been kind of pushing this narrative that things are going to slow down, but I did say November and December. And I'll tell you some of the things I think that are going to come into play. But so that was good. Richmond manufacturing came in a little bit better. No one really cares. The only thing that we have coming out on Wednesday really is the durable goods. And durable goods is expected to be down almost 1%, 0.9. And so that's a little bit negative, but I think a lot of that is just because all this stuff is stuck in containers offshore, right? So I think just a quick comment on that. I know folks are going, they're going to get somehow they're going to get everything unclogged off the boats by stacking 4 high instead of 2 high, but they're still not where they need to be, which is to the warehouses that are overbooked and on the trains and on the trucks, which there are no truck drivers to speak of. So it really it gets it off the boats, I guess, if they want to feel better about that. Now you have things stacked so high that you can't even deal with it. So that's going to be an ongoing issue. So let's talk about what I want to bring up tonight. And before I get into this, I just want you to know there is going to be a live stream after the market tomorrow. And it's not going to be, it will be market related, but I'm not going to do market analysis. I'm starting a series of streams over the next several weeks, and I'm going to show you folks how to be a portfolio manager. And tomorrow is part one of a series. I don't know how many of these I'm going to do. I'm going to unpack all of the elements, and this is what I'm all about. This is what I built the product Portfolio Expert, and also we have the WaveTech platform, which is our legacy platform, but it does, the engine runs, it does everything you need to do. And I'm really going to be talking tomorrow about Portfolio Expert and tell you more about that. There will also be a Zoom meeting for those that are already users of the platform, and we're going to simulcast that. So we're not going to be talking about a lot of these individual, anything that's pertinent to anybody's individual investing. All the questions I'll field will be relevant to what I'm talking about tomorrow. So if you have some time, 4 o'clock Eastern time, join, and then I'll be back tomorrow night at 9 as usual. So let's talk about what I really want to discuss here just for a minute. 1 second, please. So let's talk about this infrastructure deal. And I think this is kind of the mixed emotions around the markets right now from the standpoint of what they're trying to do in the government, we'll say. There's really no numbers being thrown around. I'm expecting, they got Joe Manchin to come over, so he's already said that he would go for 1.5 trillion. So that's probably what we're going to see. But I do want to talk a little bit about what all this means. And in my opinion, this is going to be more inflation. It's going to extend everything. Depending on how this money gets out there, if they can get it in the economy, there is literally hundreds of billions of dollars that came in last year on the stimulus that haven't been spent yet. And now they're going for, they wanted 3 to 5 trillion really to do all this infrastructure stuff. And I think this is very politically motivated to get this thing done. I think Joe Brandon is heading off to Glasgow or somewhere overseas to do some climate thing. So they want to show the world that America is participating in that, even though we've actually dropped our emissions substantially over the years. And while Germany's cranking up coal mines and everything else, it's the irony of what's going on right now is just fascinating. They'll have to get, maybe they'll get Greta to do a speech again. But anyway, along with this infrastructure deal is actually, they're throwing in this billionaire tax, right? So, and all of these unrealized profits and all this stuff. So everybody's been told that if you're not a billionaire, it's not going to affect you, or if you're not over 400,000, it's not going to affect you. What I was just talking about in this spending they're going to do, it is going to affect everybody. The inflation, we all know, is an attack on savings. So if you have, if you get a raise to offset some inflation, then, and the products that out there go, it offsets some of that. So it's really about sucking the savings of the country just right into nowhere, right? Just vaporizing money. And, I saw an interesting comment, somebody about crypto said, okay, you like US dollars, you want to save money, take $10,000 of dollars and stick it under your mattress, and take $10,000 of Bitcoin or whatever you want, and look at it in 5 years and see what the difference is. Of course, the dollar will still be exactly what it was. And maybe the Bitcoin will be more, maybe it'll be less. Well, that's up for debate. But I get the scenario, what everybody's putting out. And this is the whole scenario around the inflation. And, I'd like to have some time to just go on a rant on what I think is likely to happen as far as the equity markets going. I flash back to some of the things I was telling you a year ago, and maybe even back to August of last year, as I was talking about how the inflation hedge would be the S&P 500 or the indices or the stock market in general. And that's continued to be pretty much what it has been, right? You know, I don't know the exact numbers, I didn't look at them, but we're well up over 20% on the S&P this year. And all the indexes are up close to that number. So we're seeing a lot of things. I just said housing was up 19.8, markets up 20. So if you own assets, if you're in that category, everything's wonderful to a point, right? If you're savings or you don't have a lot of money, this is really going to attack everybody that has no money. And I think the irony of everything that we see going on right now is, I mean, it's laughable just on who's going to be really affected by these policies that are being thrown around in the government right now, you know. So maybe we'll get a little universal income, maybe we'll get a lot of other things, but this in the end, you know, as they say, this isn't going to age well. And the transitory, you know, everybody's moved their numbers out. Like, for instance, now the Fed is saying, well, mid next year, by July, we'll start to see the inflation slow down, or they're thinking it's going to flatten, just stay at the level. We've already experienced it. It's not going to get worse. We'll see about that. I think there's still going to be a lot of things that we're going to have to deal with. So a little bit of a rant there, but I really think I'm going to go through the interest rates here in a few minutes, and I really think we're getting closer and closer to what I've been talking about, is the dog wagging the tail again instead of the tail wagging the dog. I'll unpack that here in just a few minutes when we get into the analysis on the charts. So one last little rant. The title for this is, can earnings drive the markets higher? And I think the answer is yes. I'll go through the technicals here in a minute. But I'll go through the technicals here in a minute, but I think we're going to see maybe some hesitation for a couple of days. But as I said earlier, and when I started this stream tonight, is you're not going to see, it's not a very good policy, or it hasn't been for a long time, to be shorting or be negative as you come through earnings season. Because like I said, they're even underestimating by design, or they're really bad at what they do. And I think maybe it's a little bit of both. I think every analyst wants to make sure they meet their mark or exceeds it, so then it keeps the sentiment strong. So enough of that, you've heard that. So let's go and start to take a look at, we'll dig into the database here. And this is really interesting. I think what I'm seeing going on the database, I think it's getting more interesting by the day. On a short-term basis, we're just not getting any traction here. And you think, well, hey, we had this big move up. Looked like maybe it was a broader move, but it really isn't. We continue to see a little bit of contraction here from the standpoint of what's going on. Let me zoom in on this. And last night we were 48.9. We're now 48.25. Not a big deal, but I just would expect that we would see some kind of traction come in here and maybe see this number increase a bit, and it's not happening. So the run just finished here about an hour ago, and we have 197 new buys, 381 sells. That's where the downtick came, about 0.5% on the overall database. And you'll notice here on where the sentiment is negative sentiment, not really material, but it is a negative rotation for the next day. So we're still going to need to get this market up around 62+% bullish to really get the market rolling from a momentum standpoint. So we're just not seeing that. And we just need, at the moment though, we only need to maintain above 42%. As long as we can do that, this market's going to be able to keep some kind of enough underlying symbols or stocks in the system that is going to be able to perpetuate at least a stable environment and indicate that it's still the buy the dip market when we get to some of these support numbers that I'll talk about here in a few minutes. But the database it's solid. It's just not getting more traction, even on when you're printing up. I mean, we printed almost 4,600 today. I think it was 99 and change, but we almost got there. And last night I talked about this 4605 number, and that's been around for a long time, going back to last October. I think there's a video on, if you go back a ways to last October, there's a video, new Fibonacci projections, 4605 was that number. And it came off of the Fibonacci projection tool, that WaveTech Fibonacci projection tool. So let's go ahead and start to dig in a little bit on some of these indexes and get into the crux of the show. And I think it's going to be very interesting over the next couple of days. I was talking, just to kind of give you a setup, then I'll open up the screen, go full screen so you can see this better. But the reality is that what we're seeing here is that this grid is still flattening out, trying to roll over. We got some great numbers. I talk sometimes about no VIG and VIG, and we have VIG right now. We're at a 0.46. We're kind of getting a little bit into that range. If you go back and look at this pattern, we've just had this little rolling pattern on the upside, and it's never really gotten out of hand in any kind of parabolic curve or anything really extended that looks like, that may have, been the final hurrah and a capitulation and short covering on the upside. We're not seeing that, and we're continuing. I haven't looked at this. I want to look at a number here real quick. Yeah, the volume was pretty heavy today, and we're at 8.2 billion on a total volume of all exchanges. And I know I have this, I will spend a minute to talk about this, but I don't have the same typical view of volume. The fact that we did this at an all-time new high is a bit concerning. Usually this is more climactic in nature than anything that is going to suggest we're going to continue this rally because we had big volume. It was up on big volume. That's BS most of the time. If you look at all the big spikes in volume relative to lows and highs, you'll see most of the time the big volume days are that capitulation. I don't think this was a big one by any means. Let me just bring this chart up real quick. You can see, let me go full screen just while we talk about this volume for a minute. But you can see this has been pretty average. This is a big spike. And if you look at these numbers back on 917, I'll bring the index back up here in a minute, but 917, and then we had this little spike today. You can see it's been very steady, and we get these big spikes in volume, and they don't happen that often. But if we go back to the index, and here was the, so I need to go to cash here, 1 second here. Let me flip it over. Don't want to get too convoluted here. But right at that was a bit of a high. 917 was the day before the spike low. We got a STX buy signal here. Market's just kind of rolling. And this is what I was talking about. We're just getting this rolling pattern. And the little decline that we had in early October was one of the deeper setbacks that we've had in the pattern. So let's go back to the futures. But the pattern is setting up. I've been telling you about this 10 period moving average under here. It's 45.17. That's going to be about 45.30. And on Thursday, and then somewhere around 45, maybe 45 or 50. on as we come into Friday, as we get through this week. So we're definitely going to see this moving average come into play, and with this basic rolling of the market grid and starting to basically flatten out here, typically we'll set up some kind of little minor correction. I think one of the things that's going to happen that I talk a lot about and is this crossover. The 21 is going to cross over the 40, where it should go on Thursday. So when we come in tomorrow night on the futures, it should be through there. And typically that crossover suggests that we will get like a little bit of sideways movement, and we'll maybe retrace back in toward that 21 period moving average. And it's jumping right now at only 10 handles per day. So that'll start to come up. And normally the worst case would set up, if there was any kind of correction, probably somewhere around 4,500, maybe down to 4,480 if we had anything. But right now, until we get through that 10, the 10 has got a 40.46 ppm. So what that means is right now there's only a 20% probability to get below 45.17 today. It's not really in play. We look at the market grid for today. The play here looks like we've printed down to a low of 45.63, and S1 45.56, R2 45.83. Yesterday's high was 45.90. So if we did get up to that number 83 and we were able to print through that, then we'll retest the high and probably end up into an R3 mode. But I think S1 is not going to be a lot of downside here, but more of a flattening of the pattern than anything else. Overall, the trends are still in place. And suggesting we're going to continue on this slope. But like I said, this crossover is going to suggest that we're going to see some minor pattern here. So let's go to the cash. You see the same formation. It's interesting that cash actually expanded its volatility for tomorrow. We're looking at a cash range. We went out at 74, S1 66, R2 91. I want to show you something here. If we look at yesterday, the RTX number, let me get to the right number. Look at yesterday, the RTX number was 45.98.31, the high 45.98.53. So we went through it by 20 cents and it got rejected off of that. And I did post this pattern on Twitter on a 1 minute graph, and there was just nobody wanted to. I always call it, no one wants to be the bag man. Everybody was selling out as we came into the close, and we've seen the futures kind of come in a little positive, and now they're starting to roll back a little bit. And I think this is what we're likely to see over the next maybe 2 or 3 days. So I'm not predicting any kind of big decline or anything, but I am thinking that we're going to hesitate and see a little more rotation. I think the short-term database is going to end up telling us a lot about what's going to happen on the short-term levels, but the trends are all up. PPM1 is 0.50 on the cash, and so that's just very robust. Let's look at, like I said, look for tomorrow, just looking back at I'll give you the numbers again, but S1 45.66, R2 45.91, and if you look at the grid from that standpoint, if we get through 91, then 4,600, 4608 coincides with that weekly target number that I talked about last night at 4605. So there is a little bit of a cluster right there, and the next numbers let's just bring that up so we can talk about this. I need to put the Fibonacci numbers up here. Bear with me. So the number that's out there right now this is right here. Bear with me a second. 4605 is the old weekly number, and there was an updated number that we've 4571, and that actually that's actually already been satisfied. We closed at 4574 today. We printed 9853 on this. I think I have that. Make sure I have. I don't have. We printed 9853, 459853, and so we're coming close to satisfying at least that minimum range. The next target above here is 200 handles higher, 4768 on the intermediate. And I think this will probably end up being met. And, you know, we're still setting up for some kind of bullish pattern here, especially looking at the PPMs here on the chart, 0.30, 0.37, 0.44. The PPMs are the price pressure momentum. And I've talked to you a lot over the last year and a half since we've been hanging out, is that we're seeing this angle of attack continue. The trend is in place. It's not going anywhere. In fact, you can go all the way back virtually to, I would say right here, back to November of last year. And I remember talking about this angle and that we were going to just continue to climb on this angle of attack. And that's what's happened. You know, it's hard to believe it's just about a year later when I was talking about that. But this angle of attack is still very much in play. And you know, I talk a lot about these trend mode that happens. I'm just going to, I want everybody to have good context here. So this is what I talk about all the time. I'll draw this in. We get this momentum precedes price movement on these indicators. And I'm just drawing this in so you can see it. So what happens is you get the boost, and these are in 3 levels. So you're looking at the 10-week moving average, 21-week, 40, and even the 200-week moving average on this chart is got this upward slope as well. So we're just continuing to see this whole pattern move higher, and it just looks like to me that the probabilities at the moment is for a move up to these upper ranges in that 47 handle are pretty strong. I mean, there's just not a lot of downside in these patterns. And so it's amazing. We go back maybe three, 4 weeks ago. Yeah, 4 weeks ago. Everything looked like it was rolling over. Looked like we were going to be able to challenge the 40-week moving average. Boom. We get big reversal happens. We got a cycle hit on the dailies. Everything flips around, and this market's like it's like a perpetual motion here. It just keeps going through this whole pattern that we've been stuck into, and every time you think it's going to roll over, here it comes back again. And so, like I said, just to summarize all this stuff is as we're here in the this rotation that's going on in the markets, and even though we're trading at all-time new highs, there's still a lot of reason to be optimistic here, and we're not. I just don't see the patterns rolling over. I don't see any that stuff breaking. So I'll be a little more brief on the NASDAQ and the Russell here, but this context, by the way, will flow through all of the indexes from the standpoint of what we just went through on the intermediate view and this angle of attack and all that. So I'm just going to go through the dailies on the NASDAQ. So let's take a look at this pattern that is setting up here. The 10-period moving average is at 0.50 plus 0.24. That angle of attack is turning up. We are probably, I'm going to estimate probably 3 days away from the 21 crossing that 40 on the NASDAQ. So it's lagging a little bit, but we did get that. This is what I was talking about. We get that cycle low on 1013. It was absolutely perfect. That's what these dots are on a page. This is what I have developed here, it's a cluster of cycles that meet at one point. So it has to be 3 or more Fibonacci cycles from multiple high or lows, and they have to have this cluster. So it's not just one Fibonacci cycle. Every one of these patterns, there's a pattern finder that's embedded into all this that basically marks the highs and lows of the pattern, and that will actually, then everything's calculated from there, looking at those cycle lows, looking at the price projections that you see on the screen. All this stuff has been automated, so it's much easier to find once these patterns are confirmed. So the NASDAQ on the daily, we'll go to the market grid here just to set that up for tomorrow. Same pattern, we're down 925. Don't see a lot of big downside here, but we're looking here at the grid. Low so far 15,525, S1 15,494. The 10-period moving average below that, 15,363. That's rock solid. You see that number, buy it. Okay? There's a 0.50 ppm. So anything close to that number is going to be a buy. That's your buy the dip number there. And then if we look on the upside, right now we got 571 high, 595 is R1. Look for an R2, potential 15,651. But just like with the S&P, I think we're going to see 2, maybe 3 days. We'll see what happens here of sideways. But overall, if you're holding long positions, there's no reason to exit here because the downside is absolute minimal. So I'm looking at my Russell has disappeared here. Hang on. Let's just put it on the screen this way. Okay, so the Russell has backed off. We hit right on, look at this, 2321. I've been talking about this Fibonacci number, right? That's there. Let me bring this so you can see this on screen. 2326.70 was the target that I was talking about way back on the 12th of October. So we should head toward that number. We basically printed it almost exactly. 26 was the number. The high was 21. So, and then we reversed and closed lower on the session. So you can see the PPMs are rolling a bit. So there's a little more weakness than I was hoping for as far as the Russell goes. I'm going to go to the spread here in a minute, but this is important to understand that this Russell is remaining at least above 2255. That'll be the intermediate number. I'll talk about that probably on Thursday night's video for Friday. But this is definitely the pattern that's set up here. The next level above this, if we can just stay above the 10, 2281 is the number to watch for here. The PPM's at 0.27, so there's a 40% probability of a penetration on a closing basis. And so most of the time, 6 out of 10, you're going to stay above that 2281 number. So that should hold. Momentum, though, is really kind of mixed, and I'm going to use that term. There's no VIG. The VIG is fading very quickly here, and this is going to have to be watched really close. We could trade back in to the 2250 level, which is, as far as I'm concerned, the major support there, and that should hold there. Let's take a look at the spread. And the spread did weaken just a little bit. And we've got this setting down on what I've been talking to you about for a number of weeks now as far as this spread goes. Let me just draw this in so you can see what I'm talking about here. But this area here, This is your support zone. I didn't draw that very good, closer to right here. That's going to be your support zone, and you're really just going to work in this area, and this is fine for right now. It doesn't eliminate the possibilities of getting a rotation into these smaller cap stocks. So as usual, this will be a mid-show break here. I see I'm into this thing 35 minutes. I just can't seem to stop hanging out with you folks for about an hour every night. There's just so much in-depth analysis. Hopefully everybody appreciates it. Looks like most of the folks out there on the channel do. So, make sure, as always, subscribe and like these videos and hit the bell. That'll be really good. The YouTube folks like that. And so the rest of the show, I'm going to go through the 10-year because I think there's some things to talk about there. And then also we'll do crude oil, gold, which had an interesting day today. And then we'll finish with Bitcoin. It continues to be in focus. Looks like it's becoming a daily staple here at the Kendall Report. So let's go ahead and dig into those numbers. So one of the things I talked about last night, this is the daily, so we're probably going to move back in potentially all the way to 1.57, 1.56. And there, I mentioned in the opening comments about the dog is getting ready to wag the tail. And I've talked a lot about this in that my expectations are here from the Fed standpoint is that they're going to be forced to make a move on liftoff before they think they are. The markets are going to potentially signal that. We have not got the signal yet, but it's getting really tight. They got to be on conference calls every other day talking about it. And so, but we're sitting here right now, we're at a 0.24 on the 10 period moving average. This is daily. The next number down below is the 1.57. I'm going to bring up weekly so you can see this, and then we're going to go to the yield curve because I want to show you what's going on there. And there's a couple things I'm going to show you. Then I'll show you on the yield curve how this sets up. So for this week, and I've talked about this last night in detail, so I'll try to keep it as brief as I can. But the downside, 159, 156 could be as low as 152. I think we're setting up this sideways range. We're going to be below the big number here now is 1.85. We remember last March we hit the 175. That's a number you could hear probably 100 times a day on any of the news networks or in commentary across the internet. So that's pretty prevalent. But what we're looking at here is some really significant numbers. PPM1 is at up 250, 0.20, and 0.91. So that upward slope that I talk about in trend is there. But that 10 period moving average is way down at 1.47. And it is going up about 4 ticks. We'll call it 3. So that's going to be 150. And the following week, 152, 53, and so forth. So that's going to be the bottom end of this range. But it looks to me that things are going to continue to flatten off here and keep this pattern in place. So here's what I want to show you. I want to go to the yield curve. And this is the 5 versus the 13 week. And you can see it's been flattening. And that's important. So actually, I want to go back one step here, folks. What I want to show you is what that 13-week looks like. It is now, I've got them back up so you can see what's going on here. This is now up to 0.5. If we went back to September, right, where low was 0.15, now we're pushing 5.0. And so what's happening is the short end of the curve is moving higher while the longer end of the curve is flattening. I was just showing you on a 10-year. It's been the same price for the last couple of days, but this is, in my opinion, really something close to watch. I also want to show you the 5-year, then we'll go back to the spreads. Look at this 5-year trend. I mean, this thing is rocking and rolling here. If we go back to that same number, we go back to August, we were at 0.6. Now we're almost at 1.20, which is a double in the yields on the 5-year. And this is causing the Fed to get really close to have to at least do a quarter, maybe a half point lift off. And I don't know if these don't back off here sometime soon, the Fed's going to have to adjust rates, maybe in the December meeting. I don't think it'll happen in November, though they're willing to take the pain. But if we don't see the yield curve start to steepen back again, that's going to be important. And the way that can happen is the Fed's going to have to aim its purchases at the 5s, the 2s, and some short end treasuries are going to have to buy the shorter end of the curve to get those things to drop a little bit, right? So right now they're letting it float, or there's just a lot of movement in the markets causing it to float. Whichever, the pressures are there and building. And I would say probably 0.65 on the 5-year. I'm sorry, 1.25 on the 5-year and 0.65 on that 13-week bill. That's going to put a ton of pressure on the Fed to be thinking about how they're going to adjust rates. And I've talked to you about this a couple times. I'm just going to keep the dialogue going. But for years, we watched the Fed lead the market, all the transparency, this is what we're going to do, and all that. We've never had the market forces come into play like it was in the old days in Greenspan and Volcker and really Bernanke started the shift in with QE. And so we're used to that right now, but we're starting to see these market forces come back in play. So we'll see if this happens like I think it could, but we're still right at some trigger points. And if we can maintain these things going in through November and coming into early December, it's going to be really tough, especially if the continued pressures on inflation and all of those things keep happening. And as long as that type of configuration is happening, this is what we're likely to see, is the Fed actually being forced to do something, not leading, and they're going to have to find a way with a dialogue to get this going. Okay, so let's go to crude oil next. And this is a daily crude chart. And crude is actually just climbing that rising 10. The 10 is at a 0.52, these price pressure momentum. This gives us actually only a 30% probability for the market to close under that value of the 10, which is right now 82.88. We're trading 84.12. We're down a little bit overnight. We did print up basically yesterday up to 84.51. So we're just climbing this line. This has everything to do with the analysis that I show you every night. This angle of attack is seriously in play. Been talking about this thing since early October that we're just going to continue to climb this. Let's go to the weekly because it's even more dramatic there in that we've got the 10-period moving average is up 3.11, less than a 10% probability for the market to actually decline below that level. It's quite a ways below where we're trading right now. It's at 75.38, but it's jumping about $2 per week. So literally first week of November, the end of the first week coming the second week of November, this thing is going to be probably printing around 78 plus. And so now all of a sudden, even if there is some setting up some kind of pattern here, I think there could be a little minor fourth wave set up here and just kind of grind out. But the probabilities right now of a decline with this kind of upward slope is very low. It doesn't mean we can't come back to these numbers, but 70, 78 seems to me between 81 and 78 is going to be major lows in this market. So nothing really here to hang on to is from that standpoint. So let me go to daily gold, because gold had an interesting day today. I think some of the strength that was in the Dow probably triggered most of this, but we just keep struggling here. And I've been telling you around 97, I'll show you here in a minute, around 1797 is pretty major resistance. We traded up to 1809, the resistance all the way up to around 1805, 1808. So we printed up there, reversed back down. Now we're back to the 10-period moving average, which is right now 1785. We printed a low at 91. We look at the market grid. 87 is S1, R1 1799. So that's right into that resistance level. We'll see how it trades. It looks like it's going to stay in a narrow range. Maybe it can print back up to R2 1806. Let's take a look at the weekly, because I think this is where things are really happening here. So the weekly shows us here that we were able to close last week at 1796. We're basically maintaining that value roughly. We need to stay above 1791 as men. We'd be better above 1795 as we come into Friday. But as I've been talking about, these PPMs are bled off all their downside momentum. One more sideways week to up next week, all of these indicators are going to turn up, and all of a sudden we're going to start talking about some of these upward projections up here that are up on the chart at 1918. Won't get any more ahead of ourselves than that, but all of a sudden we're going to start to set up this tone where we're going to see this thing really start to move higher in this pattern. The risk to the downside here is in this little trend here. And I think what we got to, let me just see, 1737 was the low in here, I believe. Yeah, 1737 was the low. I don't see us getting that reversal, especially with the PPMs all starting to flatten out and lose their momentum. Like I said, one more week, a close over 1800, 1805 will be all it takes. Okay, Bitcoin next. In last night's video, I talked about potential trading down to, on the weekly, down to toward the 59 level. 57 could be in play as well. We're seeing some continued sideways here. We're just looking at a move here. Extreme, I think, is going to be 57,959. This is the weekly chart. And the upside so far this week, 63,716, R1. So basically an R1, a little bit below S1 right now, but I think there's still a potential for a rollover toward 57. I don't think we'll see the 55 handle, but we definitely see this thing rolling over. And the number that I keep talking about, let me just change this again so you can see this number better, is 60,612. 60,612. That's the number on a weekly basis we need to stay above. And this chart here doesn't close till Sunday night. Okay, so it's literally Sunday to Sunday. So on Sunday night, if we manage to stay over this 612 number, we've had 2 weeks above it so far. Typically what we'll get is once we get a couple of weeks above that number, then we'll start to see an acceleration to the upside. But the PPMs are burning off some of this big momentum that it had here. Let's go over to the daily and just look at the short term just for tomorrow. And actually, this chart updates in about 2 hours. So what we're looking at right now is the potential going down to the 21, 58, 205, low 59, 876. So it still looks like some downside. But this was the thing that I recognized on pre-show when I was reviewing this. I'm going to zoom in on this thing. And I'll show you on the chart here where I've got this. There is a cycle being signaled, cycle low for today. So if we do get a bounce off of that 58,205, the STX for today, and this, like I said, will update. I suspect it'll be a little bit lower, probably down around 58,205 when we get the update at midnight. But this is signaling a potential cycle low. So the action over the next 24 hours, when I talk to you tomorrow night, we'll be able to probably nail this thing down. And it's possible that we're setting up a pattern that I talk a lot about with the market grid, which is a dragon head. And a dragon head usually resolves itself in the previous direction. So that would suggest that we would go up and retest the highs. But we've got some work to do here. And the PPMs you can see are cutting through first and second derivatives. And so we're on the 10-period moving average, we're only 0.20, 1.02 on the 21. So that sets up, at least for the moment, that 58,200 level being major support at this time. Yeah, there. I just see a couple things. I was just looking at the some of the comments, and there is a Zoom link that will go out on email. If you're on that list, you'll get that. So we'll do that. But 4 o'clock tomorrow, live stream, no market analysis at all. And so if you ask, I'm not going to be doing that. I'm going to be focused on a series of things of becoming a money manager. And over the last 20 some odd years, I've taught a lot of folks how to manage money, a lot of it on a platform, but we're going to go through some basic high level stuff tomorrow, just things to consider. And we'll start this series off. Probably be doing it. I'm not sure it'll be every Wednesday. Could be. It just depends on what's going on here. But they will be on light. It will be a live stream, YouTube, simulcasting the Zoom meetings, and we'll keep everything to no personal information or anything, any of the folks that are managing their own portfolios that would indicate any kind of thing that you wouldn't want on the internet. So keep that in mind. Anyway, folks, as always, thanks for watching. I did it again, 55 minutes. Sorry, just a lot to talk about, and I rolled pretty hard on this thing. So anyway, thanks for watching as always, and I will see you tomorrow. Actually, tomorrow at 4 p.m. for the portfolio management, and tomorrow at 9 p.m. Eastern time for the regular show. Have a great evening and have a good day trading tomorrow.